Today's big interview is with Paul Hanratty from Sanlam. Paul, I always found that difficult to say from Sanlam, given all the years that you spent with the big green, with Old Mutual. Do you feel like you're in blue now?
Oh, yes. Oh, yes. Blue's a healthy color.
And you know, we spoke 2 years ago, just over 2 years ago, and there was a lot of furore at the time about your pay package. And I'm sure you well remember it. And I remember you telling me that you're aligning yourself with the progress of the business. And primarily it was to do with the share price. In the last 2 years, the share price has done, well, it's gone from 55 Rand to 55 Rand. So far, I guess your bet on adding improvements to the share price isn't working out as well as you might have hoped, I guess.
No, Alec, I mean, this has been one of the most difficult periods, I guess, in the company's history with first COVID, which came out of I wouldn't say it came out of the blue, but it did really come out of the blue. And, no sooner had we recovered from that. And remember that for an insurance company is just about the worst set of circumstances that you can get. And then we've got into a very extraordinarily difficult macro environment globally with markets, with interest rates, with inflation. And again, these are some of the things that have the most profound effect on an insurance and asset management business. So it's been very difficult. And on top of that, you've got the floods in KZN. But the thing to remember about any business and the share market is it's a long-term business. And we really are setting about building a platform at Sanlam that's going to take us forward, we hope, with strength for another 100 years. And, there's a lot of commitment, a lot of joy, a lot of belief that that's the right thing to do. And ultimately, for those of us who've been around longer than maybe we'd care to remember, we know that things eventually do recover and markets come back. So, it's just a question, I think, of time.
But it is interesting that all the furore about your pay pack, it's suddenly silent because it hasn't really been an issue anymore. Nobody's saying, "Oh, well, thank you, Mr. Hanratty, for giving us your time so cheaply." But when you're looking forward, how long are you giving yourself at the company? In other words, this cycle, surely when you thought about how you'd be remunerated, how long was your period?
Yeah, I've got a 5-year contract, and I'm 2 years in now, Alec. So I've still got a period to go. And, ultimately, pay is one thing, but actually building something that's important is another thing. And it's tremendously satisfying to work in a company that has, shareholders, a board, and management who are very committed to really building a great future and understanding that volatility, I mean, that's actually, that's our business, is to help people get through volatility. And that's what we're doing right now. And I don't even really think about it, much from day to day. We're very focused on the long term. The share price and so on will take care of itself.
That volatility is especially evident at the moment. We had our worst night on NASDAQ last night, or on the American stock markets last night in, well, more than 2 years, since COVID, actually, since the COVID pandemic hit. 5% on NASDAQ, 4.5% on S&P 500. On a day like this, do your team have to start calming people down, given that you are an investment company?
No, I don't think so. I think, people have got somewhat, somewhat used to the volatility now. And I think we are going to live through an incredibly volatile period. It is extraordinary. When we took our results out in March this year for 2021, I had analyst after analyst asking us about COVID, when we thought it was going to abate, what our outlook was. And I kept saying to them, you're asking the wrong question. The question you ought to be asking is what the impact of the Russian invasion on Ukraine is going to have on the global macro. And they asked why that was so important. I said, think about it. That affects every single investment that you have, wherever it is in the world. So we've entered an extraordinary time globally. The geopolitics, I think, have changed and realigned fundamentally. Um, the the surge in inflation, which is unexpected. Ours is a business which copes very well with higher inflation and higher interest rates. But the problem for any business is a very rapid and unexpected change in those variables. And that's happened. So, if you just think of a very simple practical example at Santam, we will have set premiums with a particular inflationary expectation in mind. Then this comes along and car parts might be 30% higher. If you have to repair someone's house, that might be 40% up on last year. And you've set a premium and an expectation of a 5% inflationary change. So, that's where unexpected inflation catches you. And your customers are under massive pressure because coming out of COVID, their spending patterns, they're trying to revert to normality. So savings rates are coming down. And then suddenly you get this massive push up on cost for people. And it's the same everywhere in the world. Just basic things, milk, bread, whatever, are going up, fuel, going up huge numbers. And so it impacts. And I think we'll all adjust, but it's going to take some time to get through that. I mean, the markets fell last night on the basis of a miss on inflation of zero point 0.2 in the US, zero point 0.2. That shows you how fragile, to knock a market down 5, for 8.3 versus 8.1 consensus. It just shows you how the thing is sitting on a knife edge.
Yeah, and
And
how Mr. Market has really not been taking his medication lately. The manic depression is at extreme levels.
yeah, you
But
see, I
you've
think
been
the
around
problem,
a
Alec, yeah, the problem is that the market and the world didn't take its medicine after the global financial crisis. If you think that a lot of plasters were put on and the basic problems were never resolved after 29, um, and this has been building up. So I often say joke with some of the younger people I work with, for some of us who are older, we we learned that if you print money, you get inflation, and that's been holding off for a lot. But this thing has been building up like a powder keg, and the minute that the Russians went in there, it took the market sort of a month to digest what had happened, and then suddenly, the reality struck home. All the lack of fixing things for 10 years is now come home to roost in a big way. Anyway, the world will get through this. We always do.
Mm. But you were talking earlier about Sanlam being well positioned or relatively well positioned for a high
Mm.
inflation environment. How does
Mm.
that work?
Well, look, I mean, most of our assets are real assets. Um, so in time, once the dislocation in the market is over, asset prices will inflate, at least in nominal terms. So you may be worse off in real terms, but you'll definitely be better off in nominal terms. These asset values will all come back. Where we had bond holdings on our balance sheet, aside from where we had to match fixed rand liabilities, we held almost entirely inflation-linked bonds. So those are going to stand up very well. That's exactly why you buy and hold them, for precisely this type of event. And then, of course, where clients have got assets or products where there's an underlying driver of assets, as I said, those assets will recover in nominal value in time, which means our revenue line on those will recover. And then for life cover, short-term insurance, you know, as inflation takes hold, so people are going to have to adjust their covers and they'll get wage increases. It just takes time. If we have the shock of inflation, people's wage increases will compensate for that in time, and people will then top up and restore their covers in real terms. So it'll take a year or two, but we'll recover well. There are businesses that don't do so well in an inflationary environment, but this is typically one. This is an industry that does well. Asset managers are another industry that do very well with higher rates of inflation.
Paul, before we talk about your interim results, which you have recently been on a roadshow and talking to analysts about, there was, what was it, about not even a month ago, on the 26th of August, that raid of insurance companies, Sanlam included,
Mm.
BrightRock, your other affiliate, included as well. The only company that wasn't in that raid from the Competition Commission was Liberty. So those of us on the outside are saying, we've got a whistleblower who went to the Competition Commission and told on everybody else. What's
Mm.
the story as you seeing it there?
So, Alec, look, we don't. I actually don't know anything more, nor does anyone at Sanlam know anything more than you know, because we've had zero correspondence from the Competition Commission at any point. All we have is their media statements. We've heard some of you interviewing them. So that's our best. They did not speak to the regulators in the financial services industry, so the regulators can't shed any light on it either. Um, what we do know is that they came to us with the wrong company name and the wrong address, so we did not have to admit them at all. Um, but we decided there was no harm in giving them what they asked for. We've got nothing to hide. This is a very competitive industry. We give our quote system, which is one of the issues that seems to be bandied about as the principal matter. We give our quote system to 26,000 people. We provide a code, a unique code to each one of those 26,000 people, because you have to have some knowledge to be able to use the system and not come to the wrong conclusion. So, in terms of our regulatory obligations to the Financial Sector Conduct Authority, we can't just give that to members of the public. You have to have some knowledge, and we make that available to our competitors, in the same way that I assume that Pick n Pay doesn't block the ShopRite executives from entering their store and looking at the prices on the shelves. This is an activity that I would characterize as promoting competition, not diminishing it. And then if you look at the losses that this industry's made in the last 3 years, hardly symptomatic of of any form of price fixing. If we did, we're obviously very bad at it. And then we our search warrant really stipulated two items. One, it suggested an email between two of our competitors, nothing to do with us, and it cited that we should have been able to predict that COVID would ameliorate in the current year and should have anticipated that in our pricing. So one can only assume the corollary of that is that we should also have anticipated it arriving in the first place and raised our premiums in anticipation. So that seems to be more an allegation of lack of ability to see the future than collusion. So we don't know anything. We know there have been two previous investigations in our industry from the Competition Commission. One was around the fact that insurance companies pay the same commission. That, of course, ended because commissions are regulated. So that clearly was not collusive. And then the second one was around, which took them 5 years to conclude that there was nothing untoward, is an industry practice across asset management and insurance, where we have a consistent methodology for calculating what we call the equivalent annual charge. So as you understand, products and different companies charge in very different ways. This is to try and reduce it to the simplest way that a consumer can understand it. We have a thing we call the equivalent annual charge. So if you take a unit trust, you might have one company may have an initial charge and a lower management fee each year. Another one may have no initial charge, but a higher management fee. How do you compare that as a client? So we've got a way of calculating which we agreed across the industry should be standard, because otherwise, you're comparing apples and pears. So again, the point of that was to help consumers to judge the price. And of course, that ended, but that took them 5 years to conclude that a practice that is pretty much standard around the world in financial services was not collusion. So, I can also update you that we received a letter by email. It was also it was sent to the wrong email address. So we got it a little late, but it was issued on the same day as the life insurance matter. And it said to us, because we provide home loans, it's one of the products we do, that we are being investigated together with the commercial banks, um, because all of us raise mortgage rates on the same day by the same amount when the central bank changes the prime rate. And in terms of the act, this amounts to price collusion and price fixing. So there's a number of matters, and we of course are not cited, or because we haven't had a communication as to what the particular practices or issues are. It's very difficult for us to respond. All we can do is provide you or anyone else with what I've done as the facts. But as to what the problem is, we don't know. I mean, if I look from the outside, I see an industry where market shares move quarter by quarter between everybody. Margins are thin. I think globally, this is one of the most competitive asset management and life insurance markets in the world. And there's excellent disclosure. We've got fantastic regulators in the form of the SARB and the Financial Sector Conduct Authority. I think they're absolutely world class, and I've operated in quite a few jurisdictions. We have a board, an independent board committee at Sanlam, and I think many of the other insurers would as well, who are charged with a specific job of making sure the customers are treated fairly, and they look at that in detail. So there are none of us as executives that are on that committee. So I think, this is a well-run industry, which is highly competitive, and the data, as far as we can see it, would not suggest evidence of such a thing. But of course, we don't know. This email between two of the companies that was cited in our we don't know what that email is. What I can say is that if there is a whistleblower within our industry, we have an industry body which would have been the place for the whistleblower. If any of us believed that there were anti-competitive practices, the first step is through your industry body to try to have a look at what those issues are and deal with them. So quite a number of years ago, the precursor to ASISA was the Life Officers Association. Many of us did not do credit life insurance, but we were concerned about some of the practices that did go on from some of the smaller players. And we got Judge Nienhaber to run effectively a commission of inquiry into it, and came up with regulations, well, not regulations, but guidelines that our members then had to adhere to keep things client friendly and client orientated. Those were all implemented, and to be a member of our association, you then had to adhere to that. So we've got very powerful forms of self-regulation. And I would say, if I believed that another company was engaged in practices that were not in the interests of customers, our first port of call would be to raise it at the industry body and to address it as an industry, because our industry, above all others, trust from customers is absolutely paramount. And if somebody else does something, it actually damages all of us. This has got to be understood. If you go to the bank, you don't really need to trust the bank because you get a contract at the bank and everything is fixed. But at an insurance company or asset management business, you absolutely have to trust us, because we're asking you to part with your money. Let us look after it, and we will give you a completely uncertain amount at a date that is not defined. So if I came up to you in the street, I said, Alec, I got this great proposition. Give me your money. I won't tell you how much I'm giving you back or when I'll give it to you, but just trust me. Would you give it to me? Probably not, because you're not that dumb, right? So why would you give it to Old Mutual, Coronation, Sanlam? You do it because you trust that we are going to put your interests above all others. I always say our customers' interests come before our shareholders. They have to, because trust is our currency. If we were a mining company, then the environment and human life would have to come before profits, because if you damage the environment or you kill people, actually you just can't justify that ahead of profit. And in our game, it's about trust. We really have to do, and we do everything, every fiber in our body is built around around that. And I also say to people, having seen this not only in South Africa but elsewhere, two of the big companies, at least in this country, were previously mutuals, and a mutual, the clients own the business, and you're fixated night and day on delivering to them, and that still is in the DNA of some of the big companies in this market, and you see that elsewhere as well, where you know not just intellectually but also emotionally, people are very focused on doing right by customers. So it's concerning to me if somebody has gone to the competition authorities that they didn't find a way to resolve this first. But as to what the issue may be, we are as knowledgeable as you are.
Thanks for unpacking that, Paul. It really is the first time I've heard that kind of a comprehensive view. And sometimes people don't quite get it, depending on where you stand. The point that you made about the old mutual societies serving their policyholders. I remember working at the SABC during the very brief period that it was a national broadcaster rather than a
Yeah,
state
yeah.
broadcaster, and we had the same view that the people who owned us were the public, and we would serve
Public,
the
yeah,
public, not
yeah,
not politicians. So I get
yeah.
it. I get what you're saying. Just coming back to the interims, and you did mention Santam a little bit earlier.
Mm,
uh, if one has a look at the two sides of the business, the
mm,
life insurance business, and then um, the short term or the general
mm,
insurance business, the
mm,
one offset the other in the 6 month period. And I guess the question investors always ask is, looking ahead,
mm,
is it
mm.
likely that the one that underperformed, i.e., general insurance, is going to come back?
Yeah, so look, I think the first thing, Alec, I always explain to people about short-term insurance is that it is the most volatile business in the world. People think banking is volatile with credit, but credit typically is one linked system. If you think of short-term insurance and all the different things that we insure, um, the volatility in there is extraordinary. But the fascinating thing is that um, we've got a risk management system you can imagine second to none in there. We set risk appetite limits all over the place. We use reinsurance. It's really important. If you think the KZN floods cost us, let's say, just under 600 million rand, but the actual claims run to multiples of billions. Um, it was the same with the business continuity. It might have cost us 3 billion, but the total claims were over 8 billion. So you're using reinsurance, which effectively, I suppose, in layman's parlance, is like a bookmaker laying off the risk, to other bookies. Um, so the interesting thing is when we look at this half year, which I suspect is the worst half year we've had in the company's history, and it's older than Sanlam sometime, by the way, is actually statistically the result is still within the distribution that you would expect. It's obviously in the bottom tail of it. Now, you'll appreciate that you've got limited data, so this is not but it does fit statistically, and so we think that we've got a great franchise. We Before the results came out from our competitors, we were obviously pretty unhappy about the results. But as we see the competitors coming through, we see Santam has actually done better than the others. And I think it's just a hallmark that if your franchise is better, even in tough times, you'll do relatively better. Now, it's a very cyclical industry, short-term insurance. It goes down quickly, but it can come up quite quickly as well. Now, I don't think the second half we'll get back to normality because, as I mentioned just now when we were chatting about inflation, it's not possible to put through the kind of size of premium increases immediately because you can only do them when policies come up for their annual renewal. So all companies are putting up premiums, changing benefits. I was at one of our call centers and the staff said they couldn't cope because of the volume of quotes they're getting because the other insurers are just pushing up their premiums across the board in a rather broad brush approach. And we're inundated with customers and brokers asking for quotes because people are unhappy about premium increases. So it's going to take some time. But my expectation is that 23, 24, 25 will be good years for this industry and in this business. So it is a part, of what we do. And it comes back to where you began the conversation. Our job is to manage volatility on behalf of other people. And, in the good times, in bull markets, nobody appreciates risk. If you look at the situation in Ukraine now, which produces, as you know, a very high proportion of the world's grain, um, the without insurance on those ships leaving with the wheat, they're not going to be leaving, and the world isn't going to have wheat. So, the insurance syndicates have insured hundreds and hundreds of millions of dollars of wheat, and without that function of the industry to take the risk, actually, economies grind to a halt. So I think what we're seeing now is we're really playing our role, and it's been super expensive, but this business and industry will recover. Whether it's, I don't think it'll be this next 6 months, but it'll be next year. I would expect to be a relatively good year. I think what is also, though, very important to say to you is that we put up a chart the other day for ourselves of catastrophes going back to the year 2000. And the first 10 years, 2000 to 2010, they're all little things at Santam. 2011 until to date, it's like a factor of 10 times higher. So you get this ridiculous bar chart where, the last 10 years have been crazy. The business continuity matter, that's our biggest ever catastrophe. This one, the KZN floods, is our biggest ever natural catastrophe, and it's our second biggest. So in the last 2 years, we've had the biggest two catastrophes of all time. So, and what's a bit sad is that that's not unique to South Africa. So globally, catastrophes are out of control. Now, again, I don't want to get into a climate debate or any other debate, but certainly if you're looking for evidence of negative impacts of climate change, it is abundantly clear if you look at global catastrophes and the payments from the insurance industry. People are also living in places that they shouldn't be, in flood areas and so on. Infrastructure is really bad in parts of South Africa and deteriorating, and that makes the claims worse than they should be. But infrastructure is a problem all over the world. There isn't a country, well, that's probably not true, but there are large parts of the world, even sophisticated economies, where infrastructure is not in the shape that it needs to be. So, reinsurers around the world are battling. And that means premiums are going up 3-4-fold from 2 or 3 years ago. And that's the cycle we're in as well. And you can appreciate that we cannot afford to do insurance without reinsurance. For us just to go naked, we may not be around if we do that. So I gave you some examples of the size of the gross claims versus the net after reinsurance for us. You can appreciate if we didn't have the reinsurance, Santam wouldn't exist anymore. So it's not an option for us not to get reinsurance, but it's becoming very expensive, and ultimately that cost filters through to consumers. There's just no way out of it.
It's so interesting having a look at it from the big picture and to see things in perspective over a period of time. And certainly from the press reports that came out of your interim results, that's something else that you've identified right now. And maybe, just to close off with, you can explain a little more on the idea that this is a time in the cycle when deals should be done. Sanlam has been incredible at this. Two of our partners, Easy Equities and BrightRock, huge success stories that Sanlam bought into early stage investor, and will well, you've made an enormous return on both of those. But what other deals, when you talk about deals, and maybe put that into context, the comments that have been ascribed to you?
Look, Alec, every single meeting we have with shareholders or analysts, they're trying to ask us, what we're interested in. Clearly, we're never going to get into specifics. But I think the point is that if you are doing what we're trying to do, which is to build our business and build our platforms with a focus on the long term, then we are going to be net acquirers of assets. And when you buy assets in a bull run, firstly, they all look good. Secondly, nobody who works for you ever looks at them properly. and third, they pay too much for them on they get carried away with hype. I think in this scenario, you get people who sell because they quite often have to sell, and price expectations are more reasonable. And I'm sure you'll know this, that the return you ultimately get on an asset, the biggest single factor in it is usually the price you pay up front. So, I think it is cyclically a good time. And some people balk a bit at the idea that in the very toughest times, you're seemingly taking a lot of risk. But actually, my view is that's when you're taking the least amount of risk. It's apparent risk, but it's not real risk. Because we're in the middle of a very long regulatory process to get our JV approved with Allianz, it's pretty unrealistic for us to be doing deals north of the Limpopo on the African continent, because um, it's very hard to do deals inside, the formation of a joint venture. So it'd be like taking the wheels off a flying Boeing. So we've got to limit ourselves to things that we're doing for the next 12 months, probably, to either South Africa or to India. And we'll just be opportunistic, I guess, to a certain degree, but everything we do will be within our strategy. So we'll be trying to fill in gaps in product portfolios where we have them, strengthen our distribution where we can. And we've always said we prefer to take on more of assets that we already know. That's one of the hallmarks of Sanlam. We very seldom just buy something lock, stock, and barrel. We like to come in slowly, get to know the business, add some value, and it's a bit of a long-term, more patient approach. It doesn't obviously have the blaze of glory of doing big deals, but I think it's a more effective approach because you got a lot less risk with it.